Okay, so before we jump into markets and segments, it's important to acknowledge that our industry has a high correlation to the GDP. And the highest correlation to hotel demand is really non-residential fixed investment. That's corporate investment. Both GDP and non-residential fixed investment are projected to continue to grow at above average rates through 2022. Now moving over to rate. The industry typically favorably benefits from inflation, which is CPI on this table, and the outlook for above average CPI is projected through 2023. And to date, the industry's done a great job at recovering and maintaining its rate in 2021. The tables on the bottom speak to supply chain disruption and consumer spending and saving data. Supply chain issues are a big challenge. The industry is listed as one of the top 5 affected by supply chain disruption. Looking at the table, consumer spending smoothing, the savings rate had more than doubled in 2020 to 2.9 trillion from 1.6 during the pandemic, and the majority of that sits with the high income earners who kept their jobs and did well in the stock markets. Those are the people whose savings are being spent on travel. There's been no price resistance, and consumers are buying upgraded room types. Currently, airline demand is at 80% of 19 levels, mostly all domestic. This table measures future bookings made in a week for future dates, so it's a forward indicator. The color code indicates favorable and unfavorable trends. During the past 3 weeks, airline bookings have averaged 91 to 107% of 2019 levels for future dates, far outpacing the 80% throughput to date. We saw a significant deceleration in these future bookings to 67% of 19 levels in early September due to the Delta variant, which has since obviously reversed, but expect to see similar pause due to Omicron. Orlando-Miami flight demand has more than fully recovered, and in some months, much greater than 19. Let's get a quick baseline for luxury and upper upscale RevPAR by market. Smith Travel does not break this level of detail down for just luxury. So year to date through September, luxury and upper upscale resorts outperformed, that's the top orange line, and the top 25 markets RevPAR was in the low 50%, and that's the bottom green line. Overall, luxury and upper upscale hotel RevPAR was running in the 60s. That's the first green line, where the country was around 77%. The leisure markets have almost fully recovered, so you see Miami and Tampa on the top of this table, while markets most reliant on international and corporate are at the bottom. You see San Francisco, Boston, Seattle, Washington. And interestingly, New York used to be on the bottom of this table earlier in the year, but has experienced almost sold out weekends and strong rates overall, so it's kind of making its way up the list. Now let's look at luxury only data. That's the column, the left columns. The middle column is the US overall, the right columns are the variances. ADR more than fully recovered in early 2021, that's the little red circle in the first columns. And ADR premium to 19 has exceeded the rest of the industry, as you can see from the large oval circle on the right. Now, the rest of the industry has done much better from an occupancy standpoint. Now, going into 2022, we fully expect that these leisure rates will hold, but overall rates will decline in luxury as the occupancy growth will be driven by corporate and group, which is typically at lower rates. This table is just occupancy. STAR doesn't provide, again, this level of detail for just luxury, so this is luxury and upper upscale. Transient demand has been strongest in the destination resorts, spa, and airport markets. The airport market was interesting to me. And the good news is that group index has improved to 2019 to a high of 54% versus just 30% 4 months ago. So that's a pretty big turnaround. We've seen that growth in urban and convention hotels. It's been SMERF, it's been social, It's been heavily in the warm weather destinations. Okay, so the top table here shows the total industry, historic occupancy and ADR for 2019 and 2020, and the forecast for 21 and 2022 for several of the industry prognosticators. And you can see that hotelAVE forecasts 2021 RevPAR at 76% of 19 levels. This is for the whole industry, and 88% for 2022 versus 19. Now, rates continue to surprise to the upside. For 2022, the more recent forecast, the stronger the outlook. So PwC and Smith Travel have been the most recent to forecast. You can see that their forecast for 2022 is in the low 90% of 19 levels for 2022. Let me walk you through our forecast and how we build it up, because we built it by segment. So for 2021, we're projecting leisure demand to be at 128% of 19 levels. For 2022, we're saying leisure demand will be at 110 to 115% of 19 levels. Corporate will be about 43% of 19 levels, and in 2022, 75%. Group at about 30% in 2021 versus 19, and 85% in 2022. So you can see that corporate and group are very much driving the recovery for 2022. Now, the bottom of the page, shifting to luxury only. This is PricewaterhouseCoopers 2022 forecast for luxury RevPAR at 77% of 2019 levels, again, versus their 93% for the overall industry. And they're projecting strong growth in occupancy and a decline in rate of 10%. Again, our view is that that's driven by the majority of the occupancy increases coming from corporate and group. All right, let's go by segment. Obviously, you have to look at each segment because it affects every hotel individually. Leisure represents about 50% of our industry's demand during the pandemic. That's increased to over 70%. Leisure was the first to travel in 2020, and in 2021, they traveled aggressively, no price resistance, a lot of pent-up demand, and all that savings that we saw earlier. Our data tells us that the leisure travelers will continue to buy premium room types into the long term. The booking window is still short. According to a recent American Express travel survey, 68% of bookings are for dates within 30 days. Luxury resorts ADRs in our portfolio were up over 20-30% this year. Likewise, our urban luxury hotels with a high suite mix have outperformed RevPAR versus 19. American Express Travel Partners also did a survey in August. Their spending versus 19 levels was up 12% for their FH&R program and 30% for their THC program. So again, you can see that leisure had very little rate resistance. Our forecast for 2022 shows that leisure demand growth or penetration to 19 will not be as strong as 2021. And our rationale is that there's just a little less time to travel in 2022 versus 21 as companies define their return to work protocols and schools obviously fully in person. However, because of hybrid working, technology of virtual meeting platforms, the expectation of less corporate travel, and the growth of bleisure, we're projecting a permanent upward adjustment to the pre-COVID leisure trend line. Oops. Okay, so let's do corporate. Return to the office is a critical catalyst for corporate demand to return to our industry. This table shows what percentage of offices are occupied with workers. The red line is the top 10 market average, and you can see that all markets have improved despite a slight pullback due to the Delta variant in September. We expect this to meaningfully accelerate into early 2022 as big corporate defines their return to work dates that were pushed from post-Labor Day earlier this year. Interestingly, the Texas markets show the most recovery of people back in the office. They're the ones above the top 10, and San Francisco, San Jose continue to show the highest percentage of remote workers. Airlines have said it takes 4 to 8 weeks lag time between return to office and travel. Therefore, again, getting workers back to the office is a critical next step for corporate demand recovery. The public companies reported corporate demand at 20 to 40% of 19 levels in the second quarter, and as high as 75 to 80% in the month of October. Due to Omicron, we expect that there will be a pause similar to what we experienced in September, and the duration will obviously depend upon how we manage this next variant. Our 2022 forecast, as mentioned, assumes that corporate returns to 20 to 75% of 2019 levels. The table to the right shows the corporate recovery is expected to be back-end weighted. If we take the midpoint of each of these categories, it tells us that the first half corporate demand will be at 60% of 19 levels, and in the second half of the year will be at 80 to 85% of 19 levels. Equally important is being realistic about long-term corporate demand. The table to the left is the first studies that we've been able to find to quantitatively support our thesis that corporate will not recover to pre-COVID levels. It suggests that corporate demand will stabilize at 85 to 90% of pre-COVID demand. In second quarter, Delta Airlines reported that 35 to 40% of their travel was missing because the European Schengen region, which is similar to the EU, UK, and Ireland, were not open for sale until earlier this year, November 1st. The table on the left represents the most important international markets to the U.S. Until recently, 6 of the top 10 international markets were not allowed to travel to the U.S. for tourism, representing 42% of total international hotel demand. Now they can, and that will be a boon, especially for the top 10 urban markets and other key international destination locations. Fun fact, 80% of Booking.com bookings into our New York City hotels for December is international. International travelers also have a longer length of stay and a higher spend. This table to the right shows the markets most reliant on international recovery. You can see New York, 21% of the occupancy is international, San Francisco 11, Boston 13. The lifting or modification of the government restrictions has been key to international recovery, and we're really expecting to see significant impact in the spring, summer of 2022. So I want to show you this pre-pandemic booking pace. So this is all of the major group markets rolled up. It's a TAP report for the United States, if you will. And what it showed is group demand heading into 2020 for the years of 21 to 2023, we're going to be below prior years. And what we're seeing now is that those gaps are being closed by the approximately 1/3 of group meetings that canceled in 2020 and 2021 that have rebooked for future periods. As government gathering size restrictions were lifted or enlarged in conjunction with vaccinations, we experienced significant pent-up short-term bookings, almost all inside 60 days. Some corporate, but mostly association, social, youth sports, because trade shows and associations make most of their money from conferences, meeting is key to their business model, and many of them held their events this fall. Attendance was lower, and many required proof of vaccination, but this will continue to improve, and especially when big corporate returns, because those are headline names at these trade shows, at these associations that people go to see. Our 2021 forecast projects 30%, as mentioned, of 19 levels. For 2022, as stated, we're at 85%. Group on the books for the same time in 19 declined in third quarter versus second quarter. In second quarter, all the public companies reported about 85% group on the books versus 2019 levels. That pulled back as cancellations due to Delta created negative booking pace and delayed the signing of group contracts. We do therefore expect a ton of short-term pickup in 2022 to fuel the group recovery to achieve our projected levels. And average rates are also higher. Generally, there's a contractual rate escalation of about 2 to 3% per year, so anything over 6% versus 19 is considered positive. All right, let's shift to operating costs. I know everyone's talked about this. Sourcing labor is tough. Wage rates are rising. And I don't know about you, but our operators have offered signing bonuses and many other incentives to procure workers. Our industry is short by over 1 million non-management employee jobs. Another issue for the top urban markets is that some workers left these markets never to return. This table shows that the industry was paying about $13 an hour nationally for housekeepers in early 2020. That now is at $16.50. And let me tell you, this labor challenge is not a short-term issue, and it was not created by COVID. It was another trend accelerated by COVID. We have to get a lot more creative in looking into new sources of workers. Note that 65 to 75-year-olds are the fastest growing worker segment, but also technology to reduce workforce requirements. And let's not forget about cost pressures beyond labor. Cost of sales is also an issue. The average restaurant's food cost is up over 6% year to date and over 10 to 12% versus 19. Steakhouse costs are up over 25%. Hotels in more remote destinations can't get their full orders, supplies are short, transportation's also a factor. There's a view that this normalizes in 22 or 23, although one of the larger hospitality food procurement firms are projecting an increase of 5% of cost of sales for 2022. We've done the following in our portfolio. Raise prices double digits to cover supply and labor costs, monthly menu engineering, including inflation escalators in group and catering event contracts, and simplifying menus based on available products. Despite these challenges, the industry's done a great job at reducing its break-even occupancy, even at depressed average rates, and through a series of efforts, staffing reductions, eliminating food and beverage, job combinations, brand standard relief, and contract savings. The REITs got to their EBITDA break-even occupancy at 40%. The table on the top right shows that the REITs' margins were at 70 to 90% of 19 levels in the third quarter. Mind you, the third quarter is the best quarter of the year. GOP turned positive for our industry in January. That's the table on the bottom right, and has accelerated with the increase in vaccinations. Lack of food and beverage has helped the GOP recovery. That's the table to the left. Traditional hotel restaurants and room service are money losers, and there hasn't been enough banquet demand in that department. Most of our hotels have a grab-and-go option, and our luxury hotels may have room service for breakfast or all meal periods, depending on location. In many of our hotels, we're really trying to figure out how to continue to maintain margins and avoid these pre-COVID operating losses of food and beverage while meeting guests' rising expectations on service levels. This is a work in progress that we're addressing in our 22 budgets. So there's an ongoing debate as to whether the reduced cost structure will be sustainable throughout the recovery. The last column on the right is GOP margin by year through the past two cycles. And there's two boxes, one on the bottom and one on the top. So despite the fact that as an industry, we experienced a lot of advances in operational efficiency, you could see that the margins peaked at similar levels in 2000 and 2017 instead of creating a new high. And there are a lot of cost pressures today that existed pre-COVID, as outlined on the right side. The question is, how do you rebuild the model, address consumer priorities without eroding profit improvements made? We believe that the GOP per available room can be maintained. Not really sure that margins can expand in this cycle. And just to give a touch on capital markets. The average selling price per key for hotels over 200 rooms is at 83% of 2019 prices, and for hotels under 200 rooms is at 176% of 2019 levels. The latter has influenced by 8 trades at over $1 million a key, all luxury hotels under 200 rooms. The active buyers have been the same cast of characters as pre-COVID. The REITs, the private equity groups, especially interested primarily in luxury resorts. Most of the lender sales have been at the lower end, think under $5 million, and many through the reverse auction platform 10X, think eBay. And for the most part, the sales concentration has been in the Southeast and resort destination. So how did we get to these new pricing highs despite these lagging fundamentals versus 19? A couple of things. We have quantitative easing policies leading to inflation in hard assets. We have very, very cheap debt. We have higher construction, labor, and material costs pushing replacement costs higher. And we have a ton of capital that wants to buy real estate, so supply and demand. And then therefore, willingly or unwillingly, investors have reduced their return expectations to about 17% from 20% in an effort to secure hotels. So in conclusion, corporate, group, and international will drive 2022 occupancy. Urban markets will benefit disproportionately as big corporate, individual, and group and international return. The leisure customer is structurally changed and willing to pay for more premium room types and experiences. We anticipate cost headwinds in 2022. Don't underestimate the challenges associated with rescaling operations and supply needs to accommodate more group. And because the recovery will be in fits and starts, be cautious about adding back fixed costs. Keep costs as variable as possible. Investors are fearful of the unpredictable. They're fearful of how corporate work habits will affect corporate and group recovery, and therefore it's been much safer for them to focus and pay up for the leisure-oriented assets. And debt funds have been the dominant lenders for now, but expect more competition that could result in even further reductions of debt costs. And finally, investors are willing to take a lower return for hotel assets, especially those in resorts and extended stay. And I did it. That's it. So thank you for your time.